Hey guys, what's going on? Rhett here. I am so excited to bring this video to you today. This video is going to bring your real estate investment game to the next level. And guys, if you're like me and you want to continue to grow your portfolios or you want to start your portfolio, this is something that you absolutely, no question, need to have. You need to have this for two reasons. Number one, you need to understand where your money's going, how much money you're making, and how much things are actually costing you in regards to onboarding single family rental properties or single family Section 8 units. That's number one. Number two, if you want to bring on partners, you need to understand how your money works so you can bring them a financial model like this and say, hey, look, I need 100,000 or I need to raise 50,000. Here are my numbers. What I do works, and this is why you should invest with me. Now, guys, I look at financial models all day long for big projects that I do and big developments that I do. And during the time where I was looking to create a financial model for my clients, which is pretty much what this is, all my coaching clients get this model for free. But I realized that there aren't a lot of good places out there on the internet where you can get financial models. And financial models, if you plan on doing this for a living and you want to eventually live off of the income that these investments are bringing to you, you need to understand every aspect of how this investment operates. And that is what this is. And guys, this is a little bit more advanced, but if you want to do this for a living and you want to live off passive income, you need to be advanced in what you do, and you need to be smart, and you need to understand where your money goes. So when people say, oh, hey, how much did you spend on this? Or how much are you losing every month in this? You know exactly the answers to every single question. It makes you not only a smarter investor, but a better investor that can analyze deals quicker when you see them. So guys, I want to dive into this model that I had custom made. And what I did was I took available models online. I took models that I have built for me on large scale projects and large scale build to sell and build to hold developments that I do. And I combined them. And I brought together all the most important terminology and statistics and metrics that I look at. And I basically had them shrunk down into this basically one best possible single family build to rent or acquire to rent and hold financial model. That's a mouthful, I know. But I want to dive in with you and just talk a little bit about what this is and how it works. If you want to purchase this, the link is in the description. It'll be the last financial model you ever have to buy. So let's dive in. So guys, first we have the property address up here. You can do this whatever you want. I'm making this video right now out of Nashville. So number one, you type in the property address. You guys should have a model for every single property you own. So every property should have their own independent models that you can revert back to and update, and that way you can constantly see how your finances are going, okay? So guys, these models work very north to south, and what I mean is don't look at these models from west to east, look from north to south. They all operate in a manner that is north to south, okay? So first we have our property name, type in the address, of course. Here we just did 123 Maple Street, okay? And we can adjust it. Now keep in mind too, every time you enter a figure one place, it's going to make adjustments in other aspects of this model that are going to change the outputs. So just keep that in mind, okay? So unit type, we have single family. Building size, 1,100 square feet. Of course, you can change this however you want. Bedrooms and baths. I have a 3-bedroom right here. Land size, I'm saying that the plot of land is going to be 3,500 square feet. Okay. My purchase date, I have it June 2023, but if I wanted to make it July, I could type in 7/23. It'll change it to July. Months to renovate. So how long the renovation is going to cost or going to take. You can make this 6 months or you can make this 1 month. We're going to do 1 month, a hold period of 110 months, so a little under 10 years. Months to market, meaning how long it's going to take to get the unit up and running and on the rental market and rented. Very straightforward there. Investment period, we touched on. Estimated sales date, we're going to sell this thing in November 2032, okay? And again, you can change this. It's going to change all the metrics later on that we're going to look at. All right, so as we keep going down, guys, we have a purchase price of $75,000, okay? $75,000. Now, transfer tax, we're not going to do that. Now, we can change this to whatever we want. Say we'll do $80,000 purchase price. Okay, see how it changes our cap rates as we change it, right? It's changing all that, okay? So we're going to say $80,000 to get in, no transfer tax, closing cost $4,000. That's fine. We can even change it to $4,200. Construction, our construction costs $10,000, and our going in cap rate of looking at this thing quick would be 10.19%. But you don't need to look at that now. We're going to look at the final numbers, guys. Then it's going to ask you, okay, on the disposition, which is our exit, what do we think we're going to sell it for? So 10 years down the line, we can type in something like $125,000. 10 years down the line. And then it's going to shoot out what our broker commission we're going to pay is, what the home value of appreciation is going to be. I have that in at 5%, which in some of the markets that we're in is fairly conservative when you take a 3-year average over the past 3 years. So we'll leave it at 5%. Broker commission and other closing costs, those are all conservative too. We can't calculate our going out cap because we don't know what a buyer is going to buy it for yet. So property taxes is $90, okay? Insurance, $100. Of course, we can change those. Now, don't go over here. Again, remember, we're going to go back up. We're going to go north to south. And I should say you can put your property photos in here too to make these each one of these models distinguishable between the next. So guys, this section right here is our financing section. And this, I want you to plug in all of the items that are exactly true to whatever loan that you get, okay? So if we buy a property for $80,000, like we said down here, and usually we're getting a 75% LTV, right? Because the bank's making us put down 25%, okay? That's a 7,500% LTV, that'd be nice. 75% LTV, okay? So our loan costs, loan origination, $1,100. Our loan amount is going to be $60,000, okay? Now, $60,000 is 75% of 80. Now, watch how this loan amount changes based on how much we put down, just so you can see. See, now it's at 64, so extra 5% matters there, okay? It's a difference of $4,000. So then our loan proceeds. So that is, you can see we have our loan amount, right? Less our loan costs is our loan proceeds. Now, at the bottom right here, we have our monthly payment. So you have your loan amount, okay? You have your purchase price down here. We have our LTV. Now we just type in what our mortgage interest rate's going to be. So it'd be closer to 7%. And now that's going to get us our monthly payment, okay? So guys, what I've really tried to do and what I had my builder do when he built this model is I want to try and put in as many calculators as you guys normally use into one easy place. So you're not going to 5 different websites to find the information you need. So this is a full-on mortgage calculator, okay? You can type in right here. You can go back and forth. Is it interest only? Yes or no? In this case, no, it's not. So we're going to be paying principal every month, which is important because that's going to factor into what our net cash flow looks like over the next 10 years. Now, we're not going to get into this right now, and this is a little bit more advanced, but this is going to come on all these models. You can actually enter a refinance. Okay, so look, you can say, I want to refinance this property in 5 years at a value of $92,000 at a 75% LTV, which means, and the loan's going to cost me, say, $2,500 to close, which means I'm going to get out of this. A loan for $69,000 is going to be my refi amount. We're going to pretend that the rates are lower when we refi this in 5 years. So the interest rate in 5 years is going to be 4%. That's what that number is. Our mortgage term, again, remember, it's going to be 30 years. Is it going to be interest only? No, it's not. Now our new monthly payment is going to be $329.42. And then how cool is this? The equity proceeds that we can pull out are $9,900. So it's going to actually include what that cash out is going to be. So not only, guys, is this going to be a a mortgage calculator, but it's also a refi calculator. And all this stuff will come into play as we continue to go to our next sheets of this model. Now, to keep it easy and keep it simple, we're going to say we're not doing a refinance on this, okay? As we keep going lower, we have our monthly rental. So if our Section 8 is paying us $1,200 a month, there's our $1,200. We're not doing non-refundable deposits. Deposits are refundable in the form of security deposits, so you don't have to really add anything in there in this kind of model. Property management fee taking 10%, leasing fee, which is 25%, usually on average once a year. That's usually what management companies will charge you when you go to re-up the lease every 12 months. So nothing crazy there. Vacancy for Section 8 units, I always leave it at 0 because on average our Section 8 units don't have any turnover. And if they do, we're averaging over 10 years. And in this example, we're holding the property for 10 years. So I have 0 vacancy here. Capital reserve percentage of income. We're going to leave this for now. We're going to get into this a little bit later. And then annual income growth. So we talk a lot about, guys, increasing Section 8 rents every year between 3 and 5%. So that's what that is. I have that at a 5% income growth, meaning in our equation, when we look at our year-over-year cash flow, we can assume that every year we're moving the rent up 5%, and this model is going to take that into consideration. And then down here we have our expense growth. So property taxes going up, insurance costs, and that sort of thing. And then take occupancy. Which month is the tenant going to move in? Now we can do month 7, right? It's going to change our numbers drastically and our holding costs. But we're going to say right now they're going to move in at month 2 because in month 1 we're doing all of our construction and everything else. So guys, now going back up to the top, I'm zoomed in here for clarity for this video. If I zoom out, it's a little hard to see. But when this is your model on your computer, you can view all this at once. So summary of cash flows and returns, guys. So all in, we're buying the property for $80,000, right? $80,000, yes. We're paying $4,200 in closing costs, and to get it ready for construction is $10,000. So all in, we have our $94,200. That's what we're into it for, correct? And then we have our carrying costs during renovation. So carrying costs during renovation are costs that you are still accruing for utilities and for insurance and property taxes and your mortgage and your, all your expenses when no money's coming in. So those are our carrying costs during renovation. And those are going to drastically change, guys, based on how many months the unit's vacant. So if we say that it takes us longer to do rehab and our occupancy, the month that the unit's occupied, doesn't happen until month 5, see how that changes, okay? So that's a really important metric that everybody here should know, okay? And that's why that is significantly important. Now, as we continue to go down, remember, we're going down this way. Don't forget that, okay? We have our total equity required in the deal. So based on $10,000 needed for renovations, based on our $80,000 purchase price at 75% LTV, based on our closing costs and all of our numbers, we need $35,889 in total equity to close this deal, okay? There are some extremely advanced metrics in here, IRR, which is internal rate of return, and your multiple on invested capital with and without financing, guys. These are more advanced. If you want more info on these, this is definitely for another video. That's a hour-long video in itself. I would say do some research on these. These are not really what we're going to be super highly focused on. Okay? Now, guys, as we continue to move over here, we have our exit, okay? So we have our projected sales price 10 years from now, $125,000, less broker commission fees, less our loan payoff, gives us a $67,000 net proceed. Pretty awesome 10 years from now, okay? We're going to skip that again. That's levered income, which is another more advanced metric. And then our net equity at the sale, which is realized above. And then our average cash-on-cash return over the life of the investment and our average rate of return over the life of the investment. Pretty fantastic numbers, guys, okay? So I always tell my clients we want to make sure our average cash-on-cash return is north of 10%. Here, over the life of this property, our net cash-on-cash is almost 24%, so 23 and a quarter. Guys, I understand that I'm throwing a ton of stuff at you right now, but if you want to do this for a living, these are the things that you need to know, and these are the models that you need to play around with and get good at so you understand where your money's going and how it's going that way, okay? So guys, that's it for this page, okay? The next thing I want you to do is we're going to go down to the bottom to our refurb budget. This is really, really cool. So our refurb budget or our construction budget is a renovation budget. So you can type in basically every single item and what it's going to cost you. All right, and that's basically going to, and you can add new things in if they're not in this model, and it's going to get you your absolute all-in cost for a renovation. All right, so in this example, we don't need that, so we can actually shut that off by typing in our total renovation costs up here, and that'll shut this entire thing off. And you'll have little notes throughout this model that can remind you of certain things like that. And then I say, look, if I want to be super specific, I can put all my costs in this right here, and then it'll send out a function at the bottom here of your all-in costs. Really cool. You don't have to use this if you don't want to. Again, this is giving you the option to do something that is really, really analytical. But if you just want to type in the construction rehab, then you can just do that at the top and do that easily, okay? Now, as we scroll down again, we're going to hit the next sheet at the bottom that says Capex detail, okay? This, guys, is going to bring up a capital reserve, a Capex reserve. So what a Capex reserve is, and this is not really talked about a lot, guys, but basically, and a lot of times I don't have my clients include this in a lot of our expenses. This is purely if you'd like to. What this is this breaks down how much money you should be saving every single month based on potential Capex in the future. So, for example, we have a roof right here, right? And if we say that a total cost of a roof is going to be, say, $12,000, you type in the total cost of the roof, how long the roof lasts, 25-year roof, and then say we just put it on. So it's brand new. It's got 25 years remaining, okay? It's saying exactly, it's telling you what you should amount every single year to save for a new roof after the 25 years. So it's telling you that annually you should save $480 or $40 a month, and it'll tell you exactly what year after year you should be putting away per month. So in year one, it should be $40 a month. In year two, it should be $41.20. Year three, $42.44. That's just for a new roof. And you can plug these in, you know, say we have a water heater. The water heater is going to cost us $1,500. And the water heater is going to last us, say, 12 years. It's going to change and tell you exactly, and say, again, we did this, it was brand new. So we put a brand new water heater in. It's going to tell you. Now, if the water heater's been there for 4 years already, it means it only has 8 years remaining. The numbers change. This, guys, is a ridiculous metric, okay? Nobody has something like this. But when you do huge deals and you're looking at things where Capex changes your investment return drastically, I wanted to put this in here for you in case you wanted to account for stuff like this or were interested in stuff like this. This is really, really cool. Keep in mind, every factor you plug in here, it's going to basically say, okay, well, Rhett just put a new roof on. It cost him $12,000. If you plug it in here, it's going to say that you want this in your monthly cash flow model, which we're going to look at next. So if you don't want to see this stuff and you're like, you know what, I don't really want to reserve 25 years. I'm going to sell this house in 10 years. I don't need to do any of this. That's fine. Just zero all of these out. And once you zero all of them out, you can see it's all zeros. Then they're not going to be accounted for in your monthly cash flows. Okay? Really cool. You can add things and take things out. You guys know we don't put dishwashers in our units. So that would be a dead zero, I hope, across the board for everybody. All right, guys, now moving on to the bottom again. Now we're going to hit monthly cash flows, okay? Now, don't be scared of this. I know this looks scary. Don't be scared, okay? We're going to break this down month by month, year by year. We're going to go through it quickly. And remember, if you look at these things north to south, they're not nearly as scary. So it's when you look at them from west to east, from left to right, where you are like, oh my goodness, what is happening? So guys, very simple. Top left-hand corner, we have our purchase price, right? We spent $80,000. We have our closing costs. We have our construction costs. Our total acquisition cost, $94,200. Okay, remember, in month one, we're renovating, okay? So that's why there's nothing here. There's no rental income. Remember, we're renovating this, okay? We're not making any money, no money, but we're still paying property taxes, insurance. Those are our operating expenses for that month, okay? Where if it's in parentheses, it means it's a loss. So our net operating income is minus $190. Okay, plus our debt service, which is $399 a month. That's the $589. If you guys remember, that is going to be what our holding costs are. And you can go back to the summaries and assumptions on page 1 and say, okay, yep, that makes sense. That was my carrying cost. That all adds up for me, okay? So the cool thing, we start our loan, we're owing $58,900, right? But this model literally, guys, is taking into account what you're paying every single month towards principal. So now, after the end of month number 1, you owe $5,951. Pretty awesome. This model is super, super cool and super in-depth. So month number 2, yay, tenant moves in, right? We're super excited. $1,200 is coming in for us. So our effective gross revenue is $1,200 less property taxes, less our insurance, no HOA, our operating expenses. We're going to leave that blank, okay? Leasing fee, there's no leasing fee in this month. Our property management fee is $120. So our total expenses, our insurance, our property taxes, and our property management total $310, minus the $1,200 a month revenue we're bringing in, right? Okay. Now, capital reserve. So guys, if you had plugged in that you want to save money every month for a roof, that is going to come in right here, okay? So if we go back to the Capex detail and we say, okay, well, I just put a brand new roof on, and in 25 years, it's going to cost me $12,000 to put a new roof on. It's going to cost me $40 a month in year 1. We go back to that monthly cash flow chart. Look, $40 just popped in. And it's going to come off of our net operating income, because it's going to say, okay, you need to be saving that money. And it's going to be assuming you're putting that money in a different account to save for Capex. We're not going to do that right now. So we're just going to eliminate that. Remember, I said zero it to get rid of it. You're going to come back over here to monthly cash flows. Perfect. It's gone. Our net cash flow before our debt is at $890, okay? Minus our $399 debt service nets us $491 a month, which is a 16.41% cash on cash return. Unbelievable. This number right here, guys, our free and clear return, that's more of like a cap rate at 11.31%. So our cash on cash return, it's going to spit it out, guys, literally every single month, which is so freaking cool. Okay. And then at the end of month number 2, it's going to tell us what our remaining loan balance is. Guys, remember, we can literally do this month over month for the entire term. And you see your rent's going up every single year. So now we're in, I just chose a random year. We're in year 3, month 33, okay? And look, we're in 2026. And now your effective gross revenue every month is $1,323 because we've been moving the rent up every year 5%. Remember? So that's going to continue to take all that stuff into account. And then again, your expenses are going up because we're moving our expenses up 3% per year on that first page. Remember, we're doing that? So now insurance is $106 a month. Our property taxes are $95 a month. And you keep going, you keep going. Look at this, guys. Unbelievable. We're literally accounting for every penny that we're spending for 10 years. So if we were to fast forward all the way 10 years in the future, we're in month 111. We're bringing in $1,862 a month, and that is considering a 5% increase per year. So assuming that for this same house, that's what we're bringing in, okay? Our gross revenue every month is the same at $1,862. Property taxes have gone up considerably, right? Our management fees have gone up because they're in relation to what our income is on that property. So it has our full net operating income, and as you guys can see, our 30-year fixed rate mortgage has remained the same. And that's why our cash on cash return here, guys, is so astronomically high, because as our income is going up, our expenses have remained the same. So we're at 34 point, almost basically 34.44% of cash on cash return in year 10. When we started this thing out 10 years ago, we're at 16% cash on cash return. That's why when we go back to that main page, our average cash on cash return is 32%. So that's why we get that number there. And that's important to know too. Guys, when you look at your projects like this over the long term, it shows you exactly where your money's going, how you're making money. And this is how you look at investments over the long term to know if they're going to be worth it for you. People don't do this. This is next level. And I want you, the viewers and subscribers on my channel, to always be ahead of everybody else, because this is where you get the best information. These are the things that nobody else has. These are the things that I want you to have. These models, guys, are extremely expensive to make. I mean, if I told you how much I pay for models in a given year, you'd throw up. And that's because I'm doing big developments. But even when you do something like this, it's super expensive, right? So perfect, absolutely perfect for Section 8 single family homes. I wish I had something like this when I was starting out my portfolio, because it would have helped me make decisions and I would have avoided some of the crappy houses that I bought where I realized, years later, I didn't make any money on them. I would have been able to know far closer in advance. So lastly, guys, the last piece of this is the annual cash flow. So this is going to break this down on a yearly basis. Remember, year 1, 2, 3, 4, all the way to 10. Again, work north to south. So in year 1, our rental income is going to be $1,300, $13,000, and $200. I can't say that. 13.2. Okay. Gross revenue 13.2. Our property tax for the year, a little over $1,000. Our insurance for the year, our insurance premium $1,200. Our full property management fee. Did I say management over there? That was taxes. Property management fee at $1,320. Our total operating expenses for the year at $3,600. Net operating income $9,600. And then our total debt service in year 1 of $4,790. Okay, leaving us a cash on cash return in year 1 at 13.63%. And keep in mind, guys, as our income goes up every single year, that cash on cash return is changing. Look at that. We're gaining percentage points every year until we finish this thing. Okay, so pretty awesome. Really excited. Now this is cut short. You're like, why is that so short? It's because we ended up selling this portfolio in this model 6 months in, or even less than that, or a couple months into it. So we don't realize the full value of that year because we sold it. So anyway, as you continue to scroll down here, you'll have your sales price, you'll have your net profit from the sale. Remember, all in this year. So we didn't sell anything in any of these years. That's why these are blank. As you read these north to south, you see, okay, in year 10, we didn't make as much money. Well, how come? Well, because we ended up selling the portfolio. And over the course of this thing, we made a lot of money, and you can tell exactly how much we made here. So really different, guys. This is how top-level investors analyze deals. What I would tell you is get this model and go through it and become so unbelievably comfortable with this model that it becomes your best friend. Something else too, and how this changes drastically, is if we were to do a refinance, right? So we do the refinance in year 5. The property appreciated to $92,000. We'll say it's actually going to appreciate more than that, $95,000, and we got it at 4%, 75% LTV, $95. That's why that's screwed up. Okay, $95,000. We pulled out $12,000. Now when we go to our monthly cash flows, okay, we can see that, okay, everything's going well. But then remember, in year 5, we're going to do a cash out refinance. So things are going to change drastically, okay? And our equity is going to be pulled out. And you realize that too when we do just our yearly analytics. So really cool to assume that when you do these, guys. And like I said, mess around with these things. The only way to get good at these is to mess around with them. Okay, you have to learn these, and I want you to know where your money's going, and I want you to understand where it's going. So please, questions, comments, leave them all. Remember, my coaching clients are going to get this for free. They'll have this forever. If you guys want to purchase this, get down in the description, and I'll leave the link right there at the top. And guys, use this, get better, become better investors, be more successful. This is a step towards financial freedom. If you want to work with me, send me an email in the description below as well, guys. We'll get started, and I'll see you next time.